gentlemen, and welcome to our class on technical analysis and technical indicators, sponsored by Atos, one of the world's leading Forex and CFD providers. And they're sponsoring our class tonight, as well as sponsoring the Sydney Football League and the AFC Champions in 2018. Now, if you trade with Atos, you can know your funds are safe because you're dealing with a regulated provider, as well as you get a huge range of trading resources, product ranges, all types of client support. You have an option of trading on their MT4 platform, their web trading platform, or downloading their MT4 mobile platform. You can trade on one of them or all of them. It's whatever suits your needs. For the traders, you have access to Trading Central technical analysis. You have advanced trading charts. You have an up-to-date economics calendar. You get market news pushed right out to the screen. You get updated market commentary and video commentary, all right through from Atos. You can open a general account or a premium account, or you can simply open a demo account by going to www.aetos.com. And you can do that while we're in class and follow along using their charts and their technical indicators on their platform. There's no credit card required, no deposit required. Now, you are dealing with a regulated provider, regulated by the FCA, the Financial Conduct Authority of the UK. So if you can't access Atos, that means they're not regulated in your home country and they only provide services where they are regulated. Now, because they are a regulated provider, I've got to read you a risk warning. So let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure that you understand the risk and take care to manage your exposure. Now, tonight's class is being recorded, and if you want, you can use the same link you used to come to tonight's class to see a recorded version of this class, or in a few days, you can go to www.investing.com, look under the Education tab and locate Webinars on Demand, and in fact, you can go there and see all the classes we've ever offered and watch them at your leisure. So let's move forward with getting a handle on technical analysis and technical indicators. Now, in tonight's class, I'm going to use the term security when referring to tradable financial instruments. This includes stocks, bonds, commodities, futures, indices, mutual funds, options, etc. While I may imply a specific investment, because I may say shares or indices, these investment concepts will work with all publicly traded financial instruments in which an open market exists. Similarly, I intermix the terms investing and trading. Now, we're all here tonight because we're traders. We're not actually investors. Investors buy for the long term. Traders are looking to make profit on moves in the market, whether up or down, but they're not looking to buy gold and put it away in a vault for the next 25 years. They're not looking to buy Apple stock now in hopes it'll go up 10% steadily over the years, and when you retire, sell it. That's investors. Traders are looking for short-term moves for maximum profit. They're not looking to hold on to anything for any great length of time. But they are interchangeable for tonight's class. But on the whole tonight, we're talking about trading, not investing. But technical analysis holds true for whether you're buying for long-term or buying and selling for short-term. Now, one of the biggest questions you ask is, should I buy? What will the prices be tomorrow, next week, or next year? Wouldn't investing be easy if we knew the answers to these simple questions? At last, if you're attending the class in the hopes that technical analysis and technical indicators have the answer for these questions, I'm afraid you're going to be very disappointed. However, if you're attending this webinar with the hopes that technical analysis will improve your investing and trading, I have good news for you. It will. Now, no matter where you are, no matter how you're trading, no matter how you're investing, technical analysis should always be taken as a secondary feature. Fundamental analysis like stocks, like earnings reports, headlines, press releases, global geopolitical events have a way of affecting the markets, and they're your primary effect because it's ultimately price action that determines everything and anything. So price action can change at any time. So technical indicators help support your decisions, but they shouldn't be your primary decision maker. Now, the term technical analysis is a complicated sounding name for a very basic approach to investing. Simply put, technical analysis is the study of prices, with charts being your primary tool. The root of modern day technical analysis stems from Dow theory, developed around 1900 by Charles Dow. Now, can you believe that? That's where technical analysis came from. And there wasn't online trading. There was barely a stock market. There was nothing. And in 1900, Charles Dow laid out all the basics that we're still using to trade today. Stemming either directly or indirectly from Dow theory, these roots include simple principles as the trending nature of prices. Prices discount all known information, confirmation and divergence, volume mirroring changes in price, support and resistance. And of course, the widely followed Dow Jones Industry Average is a direct offspring of Dow theory. Charles Dow's contribution to modern day technical analysis cannot be understated. His focus on the basics of security prices gave rise to a completely new method of analyzing the markets. Now, technical analysis and technical indicators especially do not take into understanding the human element. And the fact is, no matter how you want to explain it, it's the psychology of the trader, the psychological reactions to market actions that we look for in charts is what affects the market. It's the true psyche of the market. And we cannot predict how human beings will react. The price of security represents a consensus. It is a price at which one person agrees to buy and one person agrees to sell. So today they could agree to buy Bitcoin at 8,000 and sell it at 8,000. And tomorrow there could be no sellers at 8,000 or no buyers at 10,000. Okay. Now, the price at which an investor is willing to buy or sell depends primarily on his expectations. And this is what we should always realize. If a trader expects the market to go up, then his expectations are he will buy. And if he's expecting it to go up high, or he's thinking the price is very low and it's going to climb from there, okay, it's going to affect it. So if he expects the securities price to rise, he will buy. If the investor expects the price to fall, he will sell. Now, these simple statements are the cause of a major challenge in forecasting securities prices because they refer to human expectations. As well as we all know firsthand, humans are not necessarily quantifiable nor predictable. This fact alone keeps any mechanical trading system from working consistently. Because humans are involved, I am sure that much of the world's investment decisions are based on irrelevant data. Our relationship with our family, our neighbors, our employer, this traffic, our income, and our previous success and failures all influence our confidence, expectations, and decisions, regardless of whether you're a lone online trader or you're trading a big hedge fund, whether you're a bank trader. The way you woke up in the morning, the fact that you had a fight with your wife on the way, when you were leaving the house, will affect your decision because there's nobody out there basically trading from true black boxes. It doesn't have the final human element involved. Security prices are determined by money managers as well as home managers, students and strikers, doctors and dog catchers, lawyers and landscapers, and the wealthy and the wanting. The breadth of the market participants guarantees an element of unpredictability and excitement. Now, if prices are based on investors' expectations, then knowing what a security should sell for, and that comes from fundamental analysis, not technical analysis, becomes less important than knowing what other investors expect it to sell for. That's not to say that knowing what a security should sell for isn't important, but there is usually a fairly strong consensus of a stock or security's future earnings that the average investor cannot disprove. For example, what did we see happen with Facebook and Twitter over this past week? Okay. Well, tons of people are buying. Why? Facebook's not going away. They're not going to disappear. The world has an expectation for Facebook to get bigger and better, to make more profit. So they're looking for a point in which to enter the market because their expectations are once this silly press stuff is over, that it will bounce back and climb above where it was. Now, in my experience, only a minority of technicians can consistently and accurately determine future prices. However, even if you're unable to accurately forecast prices, technical analysis can be used to consistently reduce your risk and improve your profit. So the best analogy I can find on technical analysis and how technical analysis can improve your investing is a roulette wheel. And I hate ever bringing the word gambling into a trading seminar, because if you're a gambler and you think this is gambling, you're in the wrong place. But if we think about a roulette wheel in the terms of technical analysis and in the terms of money management and risk management, and in terms of making huge profits, not for the gambler, but for the house. And the house, the casino, isn't about being a gambler. It's about moving the odds in their favor. Now, a casino makes money on a roulette wheel, not by knowing what number will come up next, but by slightly improving their odds with the addition of the 0 and the double 0. Similarly, when an investor purchases a security, he doesn't know that the price will rise, but if he buys a stock when it is in a rising trend after a minor sell-off, and when the interest rates are falling, he will have improved his odds of making a profit. That's not gambling, it's intelligence. Yet many investors buy securities without attempting to control their odds. So contrary to popular belief, you do not need to know what an asset's price will be in the future to make money. Your goal should simply be to improve the odds of making profitable trades. Even if your analysis is simple, as determined with long-term, intermediate, or short-term trends of a security, you will have gained an edge that you would not have without technical analysis. Okay. This is one of the reasons automated mechanical trading is not successful on its own, because it can't use the logic to explain human emotions. Now, this is not to say tools and a computer aren't wonderful instruments, but they are exactly that, instruments. So in my totally biased opinion, technical analysis software has done more to level the playing field for the average investor than any non-regulatory event. So technical analysis, especially technical indicators, is based entirely on the analysis of price and volume. Technical indicators are just a simple field or a simple sector. It's not the whole sector of technical analysis. Technical indicators are a group of mathematical calculations that are applied to price values. Okay? And they use the open, the high, the low, and the close, as well as volume. So technical analysis is a bit of a misnomer, since it's really not that technical. A better name for the use of charts to make investment decisions might be risk-reward analysis or even market psychology. But at its core, technical analysis is simply a method of determining if an asset is worth buying or selling. Simply stated, technical analysis is the study of data generated from the market from the actions of people in the market. Such data includes price levels that serve as turning points in the past, the amount of stock being bought and sold or volume, and the rate of change of price movements over a given period of time. Technical analysis also attempts to measure the collective investor psyche, calling heavily on the psychology of crowds and the cycle of greed and fear. One of the world's most renowned technical indicators is called the VIX, known as the fear indicator, the fear index, which is basically for the stock market, but it is one of the most respected indicators in the world. Now, but what indicators can do better than most is to make a decision about what to do, to buy, to sell, to hold. Technical indicators can let you know the momentum of an asset move. Technical indicators can possibly give you entry and exit points. Technical indicators can tell you if the trend is about to end or confirm the trend. Okay, technical indicators can give you certain points of information. But price action is ultimately the most important thing. But technical indicators use open, the high, the low, and the close, and volume. This is the number of shares or contracts that were traded during a period of time, or open interest sometimes it's referred to. Now, technical analysis field of technical indicators charts always have a story to tell. However, from time to time, those charts may be speaking a language you do not understand, and you may need some help from an interpreter. Technical indicators are the interpreter of the markets. They look at price information and translate it in simple, easy to read signals can help you determine when to buy or when to sell a currency or asset. Technical indicators are based on mathematical equations that produce a value that is then plotted on your chart. For example, a moving average calculates the average price of a currency or asset in the past and plots a point on your chart. As your currency chart moves forward, the moving average plots new points based on updated price movements. Ultimately, the moving average gives you a smooth indication of which direction the pair is moving. Now, each technical indicator provides unique information. You will find you will naturally gravitate towards technical indicators based on your trade personality. And actually less your personality and more your buddy. Something that picks up your interest, something your friends talk about, something you got a hold of. I have more traders who come tell me, oh, I trade using RSI, or I trade, and I'll say, why? Oh, somebody told me it was the best. Well, that's what happens out there. We end up getting suckered into, not necessarily a bad indicator, but we never really find out what indicators are, what they're offered, which ones would help our style trading. And it's important you find the indicators that work best with you and what you need. Now, because technical indicators look at historical price data, they are not guaranteed to know anything definite about the future. Technical indicators are divided into the following categories. We have trending indicators, oscillating indicators, volume indicators. We also have momentum indicators. Now, trending indicators, as their name suggests, identify and follow the trend. Forex traders make the most money when currency pairs are trading. It's therefore crucial for you to be able to determine when an asset is trending and when it is consolidating. If you can enter your trade shortly after the trend begins and exit shortly before the trade ends, you'll be quite successful. You'll be a miracle worker also. So, two of the most popular are moving averages and Bollinger Bands. Now, moving averages are the most basic trending indicator. They show you what direction a currency pair is moving or an asset's moving. Now, the nice thing about moving averages, they take what we call the noise out of the market. Because the markets are moving up and down, bouncing all over the place continually. Whether you're using candlestick charts or bar charts or line charts, the prices are bouncing all over the place. A moving average simply takes all that bounce and takes the noise away and gives you a clear look at what the trend is actually doing. Now, the moving average is constructed finding an average closing price of an asset at any given time. You can have a 10-period moving average, a 20-day moving, a 1-week moving. You decide what time frame you're looking at, because the moving average depends on what type of trading you're doing. Are you doing short-term day trading? You doing swing trading? You trading in 1-hour increments? Are you trading in 15 minutes? Or you plan on staying in the market till the end of the day? Now you can adjust the volatility of a moving average by adjusting the time frame the indicator looks at to obtain the price. Moving averages that look at fewer time periods are to determine the average are more volatile. Moving average trade signals. Now, the nice thing is moving averages can help you get entry and exit signals, but they're too basic. Now, one of the most popular ways to trade is what we call moving average crossovers. That's taking two moving averages, say a 10-period moving average and a 20-period moving average, which one is called the slower and one's the faster. And when they cross over each other, they tell you that a shift has happened in the markets. And if the shorter crosses over the faster, it's telling you to buy. If the faster crosses over the shorter, it's giving you a sell indicator. Okay. But you have to learn how to use these first. And from there, we go over and we have one of the most renowned indicators that falls in the band, and that's called MACD, Moving Average Convergence and Divergence. We also have one of my favorites called Bollinger Bands. Bollinger Bands was created by John Bollinger, and they're an banding or envelope that goes around price. And they say that everything that's happened with that asset is contained in these bands. Bollinger Bands is typically based on a 20-period moving average. This moving average runs through the middle of the band, and the upper and the lower are plotted with two standard deviations. A standard deviation is a statistical term that measures how far various closing prices diverge from the average closing price. So as you can see here on this chart, we have the upper band and the lower band of the Bollinger Band with a moving average in the center. And we can see how it envelopes or builds an envelope around the price. Well, it's another great indicator. Bollinger Bands will also give you entry and exit signals. Bollinger Bands will help you identify the price trend as well as understand market volatility. Now, we also have a group called oscillating indicators. Oscillating indicators, as their name suggests, are indicators that move back and forth as pairs rise and fall. Oscillating indicators can help you determine how strong the current trend is and when the trend is in danger of losing momentum. When an oscillating indicator moves too high, the asset is considered overbought. Okay. When it moves too low, it's considered oversold. And these fall into the group that we call bounded indicators or bounded oscillators, because every time they're calculated using a mathematical calculation, they'll come out between 0 and 100. And they have a range. Above 80 is overbought, below 20 is oversold, and the middle zone is unimportant. So we have stochastics that falls in this group, RSI that falls in this group. We have moving average convergence and divergence, as well as the commodity channel index. Now, the commodity channel index is based on both the average value of the past price movements and how far the price movement has strayed from the average. Volatility in the currency pair, it helps measure the volatility. So as you can see on here, we have the 100 line to 200 line, the minus 100 line, and the minus 200 line, and the 0 line. Okay. Now, the CCI is not a bounded indicator. Okay, it is just an oscillator. Then we have MACD, which gives us a MACD line with a trigger line. And every time those lines cross each other, they're giving us buy and sell signals, or entry and exit signals into the market. Then we have stochastics, which is MACD and stochastics are two of the most, actually MACD and stochastics, RSI, are three of the most respected indicators that have been around, and Bollinger Bands that have been around for a lot of years. I mean, Bollinger Bands was developed in the 1970s, so were all most of these, and they still work in the online trading market and the whole new markets. And because they've been around so long, there is lots of easy to understand explanations. Plus, they've been back tested for so many years, and we know exactly how they work. Now, stochastics consists of two lines, the percent K and the percent D, and it oscillates between a range of 0 to 100. If the closing price of a currency pair is near the bottom of the range, past the closing price, the percent K will move lower. So as we can see here on this chart, we have the percent K and the percent D, and actually the percent D is simply a moving average of the percent K. And again, when they cross over or diverge from price action, they give us buy and sell signals. And as you can see on the side here, they're bounded between 100 and 0. Below 20 is a sell or oversold market, and above 100 is an overbought market. So we combine them with the above and below and the crossovers, we have certain information about the indicators. Then we also have a group called volume indicators. Because no matter how you decide to trade, no matter what decisions you make, if volume isn't supporting your decision, that means the other traders around the world aren't supporting what you're thinking. Okay, so this is the whole group of indicators. There is a very broad range. Now, they're all done on charts, and I'm going to pop you up on some live charts, and we're going to take a look at some of these right now. Okay. So here's my gold chart, and as you can see, we have the envelope around the charts. This chart is Bollinger Bands. We can see the width of the bands. That tells us how volatile or contract the market is. We have volume down below, and we can use this to interpret how the markets are moving. Over here, we have the British pound US dollar, and here we've used some chart patterns as well as some support and resistance levels with an RSI indicator down below. Here we have three indicators. We have RSI, we have stochastics, and we also have Fibonacci levels on our charts. Now, Fibonacci retracement levels are a calculation based on the prior move of the asset, and it's dropped on your charts. Here again, we have stochastics down below in the blue, combined with Fibonacci as well as swing highs, as well as your support and resistance levels. Here, we have a very basic moving average crossover. We're using two exponential moving averages, a 50 and a 78 period, and when they cross each other, that's giving us buy or sell signals. Right now, we had a relative crossover, then they separated, and we're waiting for a signal to give us a sell because we're expecting the markets to continue to fall. Now, here we have a lot more complex trading range, okay? And we're using, in this case, all types of indicators to make determinations, as well as chart patterns. Okay. Here, we're using three indicators down below, as well as chart patterns and Japanese candlesticks. And lastly, here we're using Elliott waves, or the understanding of market cycles, and this is the 5 pattern wave movement. Dropped on in each cycle of this wave movement, we have 5 going up and 3 coming down. can be seen on a chart combined with moving averages directly on a chart. But these are all types of technical indicators. They all fall into the area of technical analysis, but they're only one small part of it. To be honest with you, I use price action on a chart, support and resistance levels and trend lines and volume. That's it. So the only technical indicator I'm using all the time is volume. I believe in MACD. I support stochastics and RSI, but I don't really use them that much in my trading because I believe price action and chart patterns tell me what's happening in the markets, and that's all I need. Different people have different trading systems, different strategies, but in order for you to develop your strategy and your system, you have to understand the different types of indicators and make sure you're using the right indicators to fit your type of trading style. So on that note, I'm going to say goodnight to y'all. Thank you very much for joining us. I hope I pointed out a little bit about indicators for you. But remember, indicators are only just a very small part of the overall field of technical analysis. And technical analysis doesn't have to be scary. If you start out with trend lines, support and resistance, volume, you can have a very good trading system, and then you can slowly add on indicators. Okay, but remember, indicators are a secondary system. Technical analysis is a secondary decision to price action fundamental analysis, and technical indicators, remember the word indicator or technical indicators simply are indicators. They're indicators. They are only there to indicate. They give you information. Very few people in this world, successful traders, trade from technical indicators. They use those just as pieces of information to support decisions and make sure you get in the best market. They might point out that you're making a bad decision, but very few people actually use them to make trading. Even like MACD or when a movement gives you crossovers, it's only an alert. It's telling you there might be a potential entry system or an entry point. There might be a potential trade. But remember, price action is the overall decision maker. So on that note, I'll say goodnight to you all. Thank you very much. And go to www.atos.com. And they have a very, very, very good education section. They offer all types of classes, support material, videos, papers, strategies, and they will help you along the way. And they'll explain or answer any of the questions you might have about indicators. So on that note, have a very good night. We'll talk to you again real soon. Good night.